The surging seven stocks that have collectively outperformed all others within the S&P 500 index, have truly lifted returns. But what about the other 493 names in the S&P? We call them the laggards. So will they start to close in on those that are near the top of the leaderboard? As an investor, what should you be doing within your own portfolio? We'll find out right now on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. David Lefkowitz is back here in the studio with me to share some of the latest insights from the Chief Investment Office, particularly what's going on the equity side. And we're talking about the laggards here, David. As I said in the intro, you've got those 7 names within tech that have just really lifted the S&P index itself by weight. But what does that mean when you talk about the laggards? And maybe you can give us an example, paint a picture for us of what the Chief Investment Office is seeing when it comes to those laggards in the S&P 500.
Yeah, sure. So I think the best place to start, Anthony, is just to really give a little bit of context around some of the divergences that we're seeing within the market. You talked about the surging 7, but let's talk about the numbers in aggregate, right? The S&P is up about, call it 14% year to date. If you take out those 7 stocks that we call the surging 7, which are some of the big tech companies, the S&P is only up 3, right? So this is a huge divergence. You look at the fact that the number of companies that are outperforming the benchmark, it's only about a quarter of companies are outperforming the S&P 500. That's historically very low, right? In our data that goes back to the 1980s, in fact, this is the lowest number of companies outperforming the benchmark in that data series back to the 80s. So it's a very narrow market. You can look at this from another perspective. You can look at the equal weighted version of the S&P 500. And on that basis, kind of a similar story. The equal weighted version is only up 3%, again, versus that 14 for the normal market cap weighted version that we're all more familiar with.
Right.
So big divergences within the market. And our point here is that we think it makes sense to start to take a closer look at some of those stocks that have not kept pace with the surging 7, the so-called laggards, as we're calling them in the marketplace, because we think there's potentially some better investment opportunities there.
Yeah, and what are you advising then for clients? We'll get to the laggards in a second, but for those clients that are in the stocks that have really outperformed this year, what are you recommending they do with their exposure there?
Right. So again, I think some numbers are helpful here, right? So on average, these 7 stocks are up 85% year to date.
That is just unreal.
Staggering,
historical, isn't it?
These are staggering numbers. I think the NASDAQ is on pace for its best first half ever, right? So I mean, these are really staggering numbers, and really, at the very high end of the historical numbers that we look at when it comes to intra-market types of performance.
Right.
So if you've been fortunate enough to have exposure there, well, now you probably have more exposure than you maybe want, right? Because these particular companies they've grown so much faster than the rest of the market. You may have outsized exposure to these names. So at a minimum, we would say, take a look at your exposure, maybe rebalance back to what your target allocation should be. There's nothing wrong with taking some money off the table after a good run. And that doesn't mean eliminate the exposure by any stretch. It just means that be cognizant of how big these companies may have become in your portfolio. And that's part of the reason why we're also suggesting taking a look at the equal weighted S&P 500. It's something I had mentioned earlier.
That's right.
This is a version of the S&P 500 where each company has an equal weight. So essentially, instead of when you buy the S&P today, you're buying, it's weighted by market cap. So the largest companies get a much higher weight. So we think if you look at the equal weighted version, you still have exposure to those large companies, but just not as much as you do in the market cap weighted version. And it gives you some exposure to the laggards. Look, there's also other ways to do it. I mean, you could put some hedges on place in terms of some of those market winners this year. But the main point is that we think at a minimum, take a look at your exposures, make sure they're not higher than where you want them to be.
Right, diversification clearly is key here if you want to look down the road. But at the end of the day, and let's get into the laggards a little bit more here, David. There's a lot going on. There's still some opportunities there. But also, let's not forget we have central banks around the world, particularly here in the U.S. The Fed is looking to potentially raise rates again. If you look at Jay Powell's recent comments, he was indicating that they could raise rates depending on how they think and they feel inflation is being managed. So what impact might that have on what you see as opportunities on the laggard side or the equal weighted side?
Yeah, the way I would frame it, Anthony, is that as you think about the scenarios that are going forward, right? I mean, basically, I think there's kind of two main scenarios, right? Either we're going to have a hard landing, which frankly, it seems like the risk of that has gone down in the last few months. The economic data has been better. The Fed is nearing the end of its rate hiking cycle, but it's possible it's not done. It's possible they have to continue to ratchet higher, how much higher they'll go, and then maybe that does then increase the risk of a hard landing. So in the hard landing scenario, it's going to be really hard to justify the valuations that these 7 stocks are trading at.
Right.
Just very elevated levels relative to their own history. And let's take the other main scenario. I would call it the soft landing scenario, where the Fed completes its rate hiking campaign, inflation comes down to a level that they're comfortable with, and the economy keeps growing. Right? We don't really see any pickup in the unemployment rate, for instance. I would think in that scenario, the investors are going to rotate into some of the more economically sensitive parts of the market, and that's where that really characterizes a lot of the laggards in the marketplace. That these are some of the more economically sensitive areas. You've got energy companies in there, industrial companies in there, even some of the defensives that could see a catch up. So if we do have that soft landing, it also looks like other areas of the market could be in a better position relative to the surging 7.
Are emerging markets also someplace that you might put money to work if that scenario holds up?
Yeah, I think so.
Yeah.
I think the U.S. has been outperforming other parts of the world, especially emerging markets, and so we are recommending having what we call a most preferred position, basically an overweight stance on emerging markets. And I would say there's a very kind of big picture way to look at this, right? In the United States, you've got earnings that are kind of above trend. Usually earnings grow about 7% a year, and right now, current earnings expectations are above that kind of long-term trend. And you're paying a pretty high multiple for those slightly above trend earnings. Conversely, you look at emerging markets, earnings are depressed, arguably below normal, and you're only paying an average multiple for those depressed earnings. And so if we do get a turn in emerging markets, you could see better earnings growth and probably some multiple expansion. And I would also point out, one of the things that also helps emerging markets is that what's happening with currencies. And we just talked about the Fed. The Fed's pretty close to being done hiking interest rates. We know the dollar's expensive. When the Fed is usually done raising interest rates, usually you see the dollar weaken. And so a weaker dollar should support emerging markets as well. So, and plus, the China reopening, look, it's been in fits and starts.
Yeah, it's taken a little longer than maybe we thought it would.
Right.
Or maybe it's going a little more slowly than originally expected.
I would say it's going a little bit more slowly.
Yeah.
But now you've got, I think, a greater focus from the policymakers about, okay, do they need to take some actions in order to ensure that the reopening maintains the momentum that they want it to have? So we certainly could see some incremental policy support coming out of some important parts of the emerging market complex. So from our perspective, the risk reward looks more interesting in an area like emerging markets, and also complementing some of those other areas that we talked about.
Right, value stocks, energy, equities, et cetera, and those laggards, those equal weighted.
Yep.
David, thank you very much. Good stuff, and that's part of the latest message in focus, looking for equity laggards. And so I'll encourage everybody to go read that report or talk to their advisor about it. David, great to have you here. Thanks for joining me.
Thanks, Anthony.
Terrific. And if you'd like more information on that message in focus and anything else that's coming out from the Chief Investment Office, visit our Insights website at ubs.com. ubs.com/views. Plus, you can follow UBS on social media, and please take a look at our new Instagram channel at UBS Trending. There's lots of great studios content up there for you that you can't find anywhere else. And as always, speak with a financial advisor if you have questions about your own portfolio. Until next time, I'm Anthony Pastore. Have a great day, everybody, and remember to keep your eyes on what's trending. See you soon.